How you doing? I'm Big D. Welcome to the show. I do appreciate each and everybody that stops in. Please like, share, subscribe, hit the bell notification for all because you're going to want to see some of these things that I bring out almost daily. When I can put a show together, it does take a little bit of time, but when I can put them out, you're going to want to see these details, especially if you're a stacker, whether it be gold or silver. Now, when they told you that the bull market was over, they told you gold at $5,600 or just shy of $5,600 was the bubble. And they told you to take your profits before it fails. Well, if you're looking at short term, maybe that was a good idea. But if you're someone who's in for a long haul, especially with silver, I think it's just begun of what's going to happen. Now, today, it's tanked quite well. It's dropped right in the tank. But we are going to rebound. I really truly believe that both gold and silver, all commodities, are going to rebound. But while we were getting all nervous and stuff about watching gold and silver drop considerably, you missed the smoking gun. You missed the evidence. You missed the crime scene, so to speak. It's been, I've always warned everybody about how gold and silver are very volatile. But not this way. But I think if you watch my other show from today, you can get a better idea what's going on. And with Donald Trump coming out and speaking about his next Fed chair, it is probably that is the reason why we are in the situation we are right now. Now we need to talk a little bit about the Iran strike window has been opened. The dollar has been collapsing. But Trump endorsed a weaker dollar policy. But what happened yesterday that wasn't war, that wasn't geopolitics, that was a forced execution. That was a coordinated illiquidity event triggered by a massive margin call cascade that started in Microsoft and ended with $500 swing in gold. If you didn't sell a single ounce when silver hit its low, I believe it's bouncing back right now, but you are a legend, and you didn't take those profits beforehand. I consider you a legend as well. But I don't know why anybody would be selling their silver and gold. You're seeing what's been going on for a year or so. I mean, remember, June of 2025, silver was only $30. And to take a little hit, yeah, it's hurting a little bit right now, but you're not selling. If you're not selling, you're not losing. So please hit that subscribe button, turn on the notifications, because what I'm about to show or give you is some details about is complete forensic breakdown of the crash in the market, how they did it, and why it just backfired spectacularly. Now we're going to expose the crime. Let me start with the timeline because correlation between what happened in the equity market and what happened in precious metals is not a coincidence. 9:30 a.m. Eastern Time, January 29th, the NASDAQ opens. Microsoft, ticker, immediately plunges 7%. By the close, Microsoft is down 11.91%. That is the worst single day for Microsoft since 2020, March of 2020, I believe. The COVID crash, the market capitalization wipeout, $357 billion. This is the second largest single day loss in market history. $357 billion evaporated in one session. Now watch what happens to gold. 9:45 to 10:30 Eastern. Gold, which had touched an intraday high near $5,600 per ounce in Asia. In early Europe, trading suddenly plummeted $490 in 30 minutes. It dropped to a low just a little over 5,000. That is a 9.4% swing in half an hour. Silver, exact same pattern. It peaked at 100, almost $22. It crashed back to 107. By 10:30 a.m. to 4 p.m., gold recovered to nearly 53, almost just shy of $5,400, down only 76% on this session. Silver followed the identical V shape. By the time the market closed Thursday, it had ripped back to $115. Now, let me ask you a question. If gold is responding to geopolitical risk, if gold is responding to inflation, if gold is responding to dollar weakness, why did it crash $500 in 30 minutes on the exact same time Microsoft crashed? The answer is simple. Cross-asset margin call cascade. Multiple sources have now validated the forced selling narrative. Let me read the exact quote from the research. Hedge funds geared to rise tech stocks have been forced to liquidate long positions, and these are often the same players in the managed money category in the COMEX gold and silver contracts. Here's another one. Investors unable to meet margin calls had to sell what was liquid. Gold hit a record around $5,600 per ounce before dropping back to $5,100. When an asset has just run that far and fast, a lot of the safe haven demand is already in the price. Once the music stops, the first job is to reduce risk and clean up leverage. Here's the mechanism. Tech-heavy hedge funds were long. Microsoft, long ServiceNow, which also dropped 11.4%. Cloud stocks across the board. When those positions collapsed, they faced margin calls. Their prime broker said that you need to post more collateral right now or liquidate your position. What did they do? They simultaneously dumped their most liquid holdings, including gold futures, to meet those collateral requirements. This cross contagion explains why Bitcoin also fell 5% to 82,000 on the same day. It was at 85,000. This is not gold's response to fundamentals. This is gold getting into as an ATM by hedge funds scrambling to cover their tech losses. And the victims, retail investors who saw the $500 drop and thought the bull market was over. Let me explain why it dropped so fast. Because a $500 move in 30 minutes is not normal selling pressure. This is liquidity vacuum. This is what happens when the market makers walk away. Saxo Bank's head of the commodity strategy, Henson, provided the clearest explanation for the flash cash severity. He said, and I want you to listen carefully on this. Let me explain it as best I can. The problem is volatility feeding on itself. A price swing intensifies, liquidity thins. Banks and market makers struggle to warehouse risks, especially as their lifeline, the basis between physical and futures, narrows. When their willingness to quote prices in size fades, liquidity deteriorates, and volatility blows out. Market makers abandon their posts. Unlike equity markets where designated liquidity providers have obligations, Commodity futures rely on voluntary market making by the bullion banks. When volatility spikes above the 90 RSI threshold, the relative strength index, these banks are restrained by the Basel III capital rules, simultaneously widen bid risks and spreads, and it produces position sizes. Now, Simon Bid, head of precious metals at broker Tellet Prebon, confirmed that banks don't have infinite balance sheets to trade precious metals. Trading volume have decreased as they are taking less risks. So here's what happens mechanically when market makers withdraw. Number one, bid-ask spreads explode from 50 cents to $5 per ounce. Number two, order book depth evaporates. Those typical 100 lot bids that are always sitting there, they vanish. Number three, stop loss cascades accelerate. Sell orders execute at a progressively lower price with no offset by interest. This creates a liquidity air pocket between 5,500 and 5,100. And that is preciously where the cash occurs. The banks walk away, they pull their bids, they let it crash. They want to flush it out. They want to flush you out, actually. They want to trigger your stop losses. They want you to panic sell of 5,100 so they could accumulate at a discount. But there's another layer to this, and this is the part that makes me furious. And in weeks leading up to yesterday's crash, and today's crash, because yesterday's did rebound, and it's a little bit rebounding today, like I said. But I'm going to say today's the major crash that we're going to be talking about. The major futures exchange globally raised margins required in response to unprecedented volatility. Look at the timeline. You got January 13th, CME changed the rules to make trading more expensive. Then on January 28th, they hiked silver margins to 11%. In Shanghai, they panicked and hiked margins 3 times in 10 days, hitting 20% today. They made it expensive to be long, exactly when they knew you would be leveraged. You see what's happening? It's a plan, and it's working. Now, rising margins create a self-reinforcing liquidation loop. Let more of a death spiral, so to speak. Exchanges raise margins, and so leverage longs must post more lateral. Margin calls trigger forced sells, so prices fall. Falling prices trigger stop losses when there's more selling. Market makers withdraw, so liquidity vanishes. Price gaps accelerate, and then you go back to step one and repeat. One analyst described it as an industrial silver producers also being hit by margin calls on future hedges, making it increasingly painful to maintain projected against future production. This means both speculators and commercial hedgers were forced sellers simultaneously. This is a rare and toxic combination. The exchange raises margins to force liquidation. Microsoft crashed and triggered hedge fund margin calls. Hedge funds dumped gold and silver to raise cash. Market makers pulled their bids to accelerate the crash. Top stop losses cascaded. The retail investors who bought gold at $5,400 woke up at $5,100, thought the world was ending. And, it makes sense, right? But if you know anything about gold and silver, you stick with it. It always comes back. But here's the best part. The trap failed. Gold panic low yesterday, today 5,100, but it's lower probably by now. But like I said, I do see it coming back. Now this morning, it was still tanking a little bit, and I did see it coming back a little bit. So recover percentage is about 5.5%, distant from its all-time high of 55.97ish, only 3.8%. But silver panic low is 107. Current price now is low 90s an ounce. The recovery speed and strength indicates bargain hunting demand absorbed the entire liquidation wave. Now, after the price of gold plummeted by the nearly $500, bargain hunters increased their buying activity, helping the price of gold recover. And who were the bargain hunters? The physical buyers. India. Gold imports are expected to decline due to high prices, dampening jewelry demand, but investing grade bar and coin demand surge of 70% year over year. Q1 2026, China spot gold switched from discount to a $3 premium over the London benchmark after the price correction, signaling retail demand remains robust. ETF flows, even on gold's worst single day decline in 12 years. North American gold ETFs record inflows of 334 million, 2.3 tons. Now outflows are inflows. This is the telltale sign of the liquidation driven dip, but a demand collapse. And then institutional buyers distinguish between technical selling, which is a short-term noise, and fundamental value, which is long-term signal. They saw 5,100 and they bought. They started buying. They saw the 107, but now it's down to 92. And by the time the retail panic sellers woke up, the price is already back again, but not as high as it was. It's going to be fun to watch on Monday morning. Shanghai, I believe, opens Sunday evening, and maybe get a preview Sunday evening of what is going on in the precious metals market. Now, if demand had collapsed, we would still be down. But I just want to say thank you for stopping in and listening to what I have to say. I think we're going to be okay. And they get you to sell your stuff by freaking you out like this. And that's what changes the price in the market so rapidly, along with the Fed chair being chosen. So let's try to get today past. Let's get past today, and then see what happens Monday. We do have I have a good feeling about what's going to happen Monday. But let's check it out. Let's see what happens. Try to have a great rest of your week, and have a great weekend. Stay safe. God bless.